Hey everybody, it's Pete Carmasino here on this week's halftime show on StockCharts TV. Thanks for tuning in. Each and every week we kind of go over some different things, some different parts of the markets we're seeing. And today we're just going to talk about the market in general. We see a lot happening here. Markets were up 4% last week, Nasdaq and S&P that were anyway. And we're looking for maybe a follow through this week. So typically when you start to see that, maybe you start to get a little bit more bullish, a little bit more activity, a little bit more money flowing into the market. So that's good, but we just don't know if this is an area of an opportunity to potentially fade this rally. A lot of folks are talking about that obviously we've got interest rates are moving higher last week and market really rallied into the Fed thinking there was a pivot there. I didn't really see it specifically, but we do and have been seeing commodity prices and things come in. So the fact is, there's obviously a little lag and maybe a little bit of slack in these rate hikes. So another rate hike into receding prices would potentially give markets some possibility and again, some opportunity to think that the Fed might slow down at the next meeting just because you're going to have a few more months of data before the next official meeting. That doesn't mean the Fed can't act in between. They can. But what we're seeing here today is we're seeing the names that are most likely most affected by higher interest rates, like autos, internet retailers, discretionary names in general, home builders, all rallying today. So that's giving the market kind of a different look here and sort of a different shade of opportunity and positivity. And that's kind of what we like. So we're going to do a few things today. We're going to go over the market. Obviously, we're going to look at some index levels. We're going to look at some ratios, the discretionary to staples, value versus growth, a quick look at some ratios. Okay. That's all we're going to do for there. And then obviously we're going to look on to the ACP platform and the Chaikin platform, but I've got one particular fund, an ETF that's standing out. Now it's not so much the fund, but it's actually the constituents. What's inside that fund are really strong stocks that are literally mid to large cap type names that have both strong fundamental and strong technical characteristics. It's kind of what we like to find. That's really what the Chaikin system is about. And so having an area that you can look into to find those names, specifically is kind of helpful. It's really quick and easy. So let's dive into the note here today, and we'll look at some charts here to see what's happening. Okay, as I said, is this the start of a follow-through week or not? I mean, I wish I knew for sure. And I wish we had a concrete answer for you. We don't. I mean, the market's rallied over 4% last weekend. Again, S&P and Nasdaq, that is. This morning, the follow-through looks really healthy. Markets are looking great. But I think the question that still remains is, should this be traded or faded? In other words, if we get a pullback to support on the S&P in general, and again, the Nasdaq as well, and maybe the Dow, but we look at the S&P, right? It's kind of the barometer of the overall market. If we get that pullback to support that 4,100 level, that 410 on the SPY, if that holds and bounces, that could be another pivot point higher. Now, we've seen 2 or 3 rallies already. We're in the third one right now on a weekly basis, and we're going to look at the averages there. But today we're seeing discretionary names lead: autos, internet retailers, as I said, restaurants, home builders, all of these. Some positive news out of the July ISM. That was really the worst report since June of 2020. All right. It was just shy of June. June was 53. This came in 52.8, but it was better than expected. 52 was the expectation. So you got to squint to see the differences here. The delta is very small, but what came out of that report were prices were receding. And we've been seeing that. We talked about this many times. Inflation is happening as we speak. Go out and look at your grocery bills, your gas bills, things of that nature. You're seeing that prices come in a little bit. Now, the problem is we're getting used to higher prices, but the fact is when a report comes out on the ISM manufacturing and you see prices coming in a little bit and the index not diving or anything of that nature, orders were down, don't get me wrong, but they weren't down that much. Again, that worst report since June of 2020, but again, we got to take that in stride. And I think that's what the markets have done. Let's look at the index levels here like we do every week. And we're going to start with the S&P on a weekly basis, the bullish percent. Okay, so here's what I said. This is rally number 3 that's underway. We're moving higher here and seeing the bullish percent get better and better. So I look at this on a weekly basis. This is a weekly chart, and these moving averages are on a weekly basis as well. So you've got the 55 EMA there. You've got the 200 weekly on there, and we're obviously we never broke that 200-week moving average. That would be important. Now, we did that back in the pandemic, but it was so brief and so fast and so quick that the Fed acted immediately and brought support to the market. So as I see this rally getting right into that 55-week EMA, I just can't do anything but really assume that that's going to be resistance, but we just don't know. But let's look at what the rallies have delivered already. Now, you're seeing rally 1, 2, and 3 here, averaging about 11.6. One so far, and that's today, not including the close. That can change. Again, that means the average can go up or down. But around 11 to 11.5% on average is what we've been seeing. That doesn't mean that's going to continue. We just don't know. Bear market rallies can go as high as 20% sometimes. Again, and they could be longer. They can extend as far as time. So we might see this market live around these levels of 4,100, maybe for the bulk of August. But again, as liquidity starts to come back in, the back to school market starts, we start to get more sort of normal situations out there in the market. And obviously we start to look ahead as a market instead of looking in the past. That's why guidance is so important now when you're starting to see names like Apple report and tell us things are okay, where a company like Walmart is saying, hey, look, we've got some issues here. We've got some inventory levels, and Target came out and said the same thing. And then obviously the dollar can be impacting some of these multinational names too. So you got a lot going on. Again, right now where we are is up over 13, probably almost 14% on this last bear market rally, which is pretty impressive. Looking at the Fang index, again, that's a multiple names that all the big names, the Metas, the Googles, the Apples, the Amazons, Netflix, a lot of other names in there. And a few Chinese names like Baidu and Alibaba are in there as well. So when you start to look at this in general, you see that it's also up against resistance, even though you're seeing the interest rate, which really affects these technology names more than most other sectors. But that's not really diving. I mean, the rate's down. Don't get me wrong. We were at close to 3.5% just a month and a half ago. But right now, that index is kind of meandering to the upside. It's not really showing a ton of power, and the RSI is not really breaking above the midpoint either. So let's just keep that in mind. I mean, we got to take it for what it is, but we can't lose sight of what's happening here in the market. Sentiment, I like the AAII Sentiment. You can go on Twitter and just find them. That's their Twitter handle there, at AAII Sentiment. And last week, you're just seeing bulls and bears kind of switch positions here a little bit. But really staying in the 40% for 3 weeks in a row, that's above, all right, think about it. It's about 33% above historical norms for 3 weeks in a row. So you typically get too negative. What happens? Market does the counter trade, right? Goes the other way. When sellers get exhausted, buyers come in, short squeezes happen, and things of that nature start to play out. And so that's really what you see. You're seeing trend followers come in, maybe affect the market as well, maybe supporting the move higher. But obviously, you're just seeing the sentiment is being driven by market activity, not the other way around. So equal weight ratio on the discretionary over consumer staples. I like this because it just kind of gives you an even overview about what's happening. Look, we're above the 55 and holding. That's very, actually, that's very, very interesting. But at the same time, we have a huge spread between, again, the daily 55 EMA and the 200 day. It's the 55 is flattening out, but I mean, it's flattened out before. All right? That doesn't mean really anything. You have to take this in stride. But at the same time, even if we got up to that 200-day level, by the time that happens, we might be at this other area of resistance. And so you kind of have to look forward a little bit and time it and kind of say, okay, is it really out of the woods, or is there other opportunity? But if you look inside the actual indexes of these particular ETFs, the names that are in there, you might find some better opportunities than just by looking at a ratio chart. But the ratio chart can kind of tell you a lot as well. Value over growth, obviously, we're seeing that pullback. Value gets sold and growth gets bought. And there's your interest rate level here, kind of playing into that narrative and that theme. But again, midpoint's holding, even though it put it in a lower low. It's something to be aware of. The S&P from July, we saw this move higher. We were talking about 4,100 to 4,150 being sort of an area of resistance. And today, that's kind of where we are. That's actually today's chart. And again, this 3420 would be a drawdown of 29% from the high. Okay. And so it's still not off the table, but I'll tell you, this chart does look pretty good and you can't ignore it. But 4,100 would have to be tested, held, and then obviously maybe there could be some catalyst to get us above that 42 to 4,300 level. Again, that would be impressive, but certainly not out of the question. So looking at the SPY, we're right on resistance there, the ones we've been drawing out for months, overbought as well. Relative strength weakening a little bit, but good Chaikin money flow. Qs, kind of the same thing, right up against resistance, right above our levels that we saw before. And then IWM, one of the most impressive charts here, coming off of the levels of 170 to 175 that we had called out for many months. Again, overbought, Chaikin money flow strong. Do like the setup here, but it is really up against resistance. Even though it's broken out of that trend, you've got these horizontal resistance levels that are pretty strong. And I would think if it can get above 188 and live above there for a few days, 200's next, that's going to be a taller task. So don't want to get head faked here, but you do have to pay attention to it. Okay, we only have a few minutes left. I just want to point out that, you can follow me on Twitter at Pete Carmasino on Twitter. I put out some things in the interim. If you don't want to wait for the weekly videos, you can follow me there and just find some other anecdotal information that I put out. And then I start to look at this particular ETF. It's called WGRO. It's the WisdomTree U.S. Growth and Momentum name. And I'm pulling that up. Just kind of looking at the chart itself, because the fund itself is not that impressive, to be honest. It's really become a really good spot to kind of look at for other opportunities inside. So the constituents are more attractive than the potential fund is from my standpoint anyway. I don't see a lot of assets in here. It's got a decent expense ratio. It's got a better beta than the market, but I mean, obviously it's in a downtrend. It's new, it's less than a year old. And I think it's probably an interesting spot to kind of look at for some other areas. I want to go back to just some names we talked about a while ago, which were the energy names. And as I said to you, we were looking at the renewable energy. Let me rephrase that. The renewable energy names were looking strong. I mean, Enphase is one of the biggest moves we've seen, and this was trading around $200 when we talked about it a few weeks ago, and it wasn't bullish. We just turned bullish. But let's go back and look at this really quick. ENPH, I'm going to pull up on the fly here. I know I'm going off script here, but so as I wait for the chart to build, I can see we just turned bullish. Right now we were neutral, but just again, power gauge, the relative strength were all signaling. So technicals sometimes move ahead of fundamentals. Happens a lot. It happens a lot. And that's what's leading me to this fund. This fund is actually using both fundamental and technicals. It's based off the O'Neill Growth Index. William O'Neill and Company, if you don't know them, look them up. Bill O'Neill started IBD. He's got an interesting philosophy, and he's become sort of a master stock picker over the last 50 years. But the fund is based off of that methodology. It's this very similar to what we use here at Chaikin. And so what I'm finding is this is an opportunity to find multiple names in multiple industries that are both having strong trends and are in the strong industry themselves. And I'm not talking small names. I'm talking Merck, Hershey, Eli Lilly, Marsh McLennan, Centene. Here's a small name, a smaller steel name, CMC Commercial Metals, right? If I look at the market cap on this, it's a mid cap, but look at the revenue, $8.5 billion with a $4 billion market cap in a market that could be starting to grow. I think it's an interesting spot to start looking for some ideas. Again, WGRO is the symbol of the fund. All right, everybody, that's all we have for today. I appreciate you tuning in, and each and every week we'll be coming back here on the Halftime Show on StockCharts TV. Again, Pete Carmasino. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.